Hello and welcome back to The Note, coming to you early today to report on a rather frightening amount of turmoil in world markets. Now, to start off with, world stocks are now officially in a bear market. The FTSE All-World index is more than 20% below its peak from last year. But in many ways, that's merely the tip of the iceberg. What's really going on is being driven in bond markets and currency markets, and it reflects a loss of confidence in central banks. Now, if we take a look at the currency markets, you can see that both the yen and the euro have strengthened very sharply against the dollar in the last few weeks. Now, this is emphatically something that wasn't supposed to happen. The Fed actually raised rates in December of last year and has advertised its intention to do so a few more times this year. If you raise rates, that attracts money towards the higher rates on offer. Meanwhile, the European Central Bank has resorted to negative rates, was very clear about that back in December. The Japanese Bank of Japan announced in January, much to everyone's shock, that it was moving to negative rates as well, that it paid on reserves. So this should plainly have strengthened the dollar against them. Instead, as we can show you if we move to the next chart, the divergence trade has instead shifted in the other direction. What we're looking at here is the extra yield on 2-year bonds you get here in the States compared to Japan or the Eurozone, and that gap has narrowed. What that means is that the growing belief over the last 6 weeks that the Fed can't possibly go through with its tightening, and even that it might be required to cut, has utterly swamped what has actually been done by those other big central banks, the ECB and the BOJ. That's very worrying. It suggests that central banks with the messages or actions can't actually get the outcomes they want. Now, that doesn't mean that what central banks have been doing has had no effect at all. If we take a look at this next chart, it shows you how Japanese bank shares have done and also the multiple that investors are prepared to pay for those bank shares. And you can see there was a really startling fall for Japanese banks after the Bank of Japan announced that it was going to start charging negative rates on deposits on January the 29th. Now, this should technically be straightforwardly a penalty for banks. It means that it costs them more to leave reserves with the Bank of Japan. There was, however, widespread belief in the market that negative rates wouldn't necessarily impinge on banks' profitability. That was certainly what the BOJ was hoping. We've seen research suggesting that other central banks could cut rates very much more negatively than they are now. And indeed, the Swedish Riksbank announced further negative rates today. What we've seen in Japan plainly suggests that investors don't believe this, at least investors in banks. You've also seen sell-offs in European and US banks, which reflect the same concern. Now, one final point, if we take a look at this final chart, this shows you two of the most popular and successful ETFs here in the States over the last few years. They invest in Europe and Japan on the basis that their stock markets will be boosted by easy money, and they hedge out the currency because obviously there's a risk that the easy money will weaken the currency. As you can see, those trades did very, very well for a long time, and now they've gone very drastically into reverse. Not only the stock markets falling, but those currency hedges are now losing you money, not gaining it. There are very many investors who had made trades similar to this who will be sitting on similar losses, which will mean obviously that there is a risk that those losses start to cascade. There is every reason to fear that this is not over just yet. And that, I am afraid, is the gloomy prognosis for now. I'll be back later once Wall Street is closed.